Welcome to this deep dive, especially for all you Stock Explorers listeners out there. Today, we're really zeroing in on First Solar. They've been making some serious waves, and, well, if you're thinking about investing in solar, they're definitely one to watch.
Absolutely.
We're going to break down what's been happening lately, the key things impacting their performance, and we have to start with these new tariffs, the ones people are calling Liberation Day.
Indeed. They kicked in April 2nd, 2025, and yeah, definitely caused some disruption. But what's really interesting, especially for potential investors, is how First Solar reacted compared to, well, most of the competition.
That's right. It was pretty striking. While, a lot of solar stocks dipped after the announcement, First Solar actually saw a bump, didn't they? About 5% up on April 3rd.
Yeah, hitting around $137 a share. That difference really stands out.
It really does. So the obvious question is, why? What's different about First Solar here?
Well, the big thing is their position as a major U.S. manufacturer, and crucially, their technology, that cadmium telluride or CDT, thin film stuff.
Right, the CDT.
Exactly. Unlike most other panel makers, they don't rely nearly as much on polysilicon. And since most polysilicon comes from overseas and is hit by these tariffs, First Solar has this, well, built-in advantage right now.
Okay, so that focus on U.S. production is really paying off.
Yeah.
But, supply chains are global, right? They can't be completely immune, surely.
That's a very important point. While they don't need much polysilicon, they do still import some finished modules from Vietnam, Malaysia, and India, actually.
And those are getting hit.
Oh, yeah. Vietnam faces a hefty 46% tariff, Malaysia's at 24%, and India's 26%. So while it's less exposure than others might have, it's definitely not zero. It's something they have to manage.
Okay, 46% from Vietnam.
Yeah.
That's significant. So what's the estimated financial hit? Even if they have ways to lessen it, that must add up.
Well, Christine Cho, an analyst over at Barclays, she put out an estimate. She thinks the annualized impact could be getting close to $500 million.
Wow, $500 million.
Yeah. And for the rest of this year, say April through December 2025, she figures around $375 million of that impact could hit. So yeah, it's a pretty substantial number they're dealing with.
Definitely not insignificant. So how are they planning to handle that? Are they just going to, eat those costs?
Not entirely, no. They have a few strategies. First off, they have this huge backlog of contracts, right? And apparently a lot of those contracts have clauses built in to deal with tariff risks.
Like sharing the cost.
Exactly. Some kind of shared responsibility setup. So that gives them a bit of a cushion right off the bat.
That's smart planning. Hedging against trade policy shifts. What else can they do?
Well, they've got flexibility in where they source their imports from. They could, for example, try to shift more production meant for the U.S. away from Vietnam with that high tariff maybe over to their Indian factories.
Makes sense.
There's even talk they might redirect about 700 megawatts of production from India stuff that wasn't already committed directly to the U.S. instead of bringing in modules from Vietnam. Just doing that could potentially save them like $30 million this year alone.
Okay, so optimizing their global footprint to dodge the worst of the tariffs. And then there's the domestic expansion we keep hearing about. How does that fit in longer term?
That's really their main long-term shield. The more they build here in the U.S., the less they need to import and the less these tariffs matter. That big new plant in Louisiana is a perfect example.
Right, the one they say will churn out panels super fast.
Exactly. And, BMO Capital Markets seems to agree with that long-term positive view. They just reiterated their outperform rating, kept their price target at $230.
And their reasoning?
Their thinking is basically these tariffs on Southeast Asian imports will likely push up the average selling price for all solar modules, and that kind of environment actually helps domestic producers like First Solar, who can then command better prices.
Interesting. So a short-term headache with some import costs, but the overall effect of the tariffs might actually work in their favor down the line because they make so much here.
That seems to be the argument, yeah.
Okay, let's shift gears a bit. Beyond the tariff news, how's First Solar doing financially overall? They just reported their full 2024 results, didn't they?
They did, and the numbers looked pretty strong. Net sales hit $4.2 billion. That's up 27% from 2023.
Wow, 27% growth. What drove that?
Mostly just selling a lot more modules. Volume was way up, and their fourth quarter was also really solid, $1.5 billion in revenue, which is up 31% compared to Q4 the year before.
Good momentum then. Profitability, how did that look?
Also looking good. Q4 net income was $393 million. up about 12.5% year over year. For the full year 2024, their earnings per share diluted came in at $12.02.
Okay. And Q4 specifically?
Q4 EPS was $3.65. That's up from $3.25 in Q4 2023. So solid profit growth, too.
Healthy numbers. And I think I saw something about their cash position improving quite a bit.
Yeah, that was noticeable. They ended 2024 with a net cash balance of $1.2 billion. That's up significantly from $0.7 billion just the quarter before at the end of Q3.
What caused that big jump in cash?
Two main things, really. They got proceeds from selling Section 45X tax credits. Those are the IRA incentives for U.S. manufacturing, which we can touch on more, and just strong operating cash flow from selling all those modules.
Okay, so a pretty solid financial base to work from. What are they forecasting for this year, for 2025?
Right.
They must have given guidance.
They did, and it's quite ambitious, really. They're projecting net sales between $5.3 billion and $5.8 billion.
So potentially another 30% plus revenue growth.
Roughly, yeah, around 32% growth at the midpoint, and earnings per share guidance is between $17 and $20. Their year-end cash balance is expected to land somewhere between $0.7 billion and $1.2 billion again.
Those are some big growth targets. How does their valuation look right now, given
Yeah.
those numbers, compared to others in the solar space?
Well, that's interesting, too. Based on current numbers, their price-to-earnings ratio, the PE, is sitting around 10.6, which, considering the growth they're projecting, might look pretty attractive to some investors, especially within the energy sector.
Okay. So strong financials, optimistic guidance, and maybe an attractive valuation. Let's dig into the manufacturing side more. We know they're expanding. What's the capacity picture now and looking forward?
Right. So they finished 2024 with about 21 gigawatts of global nameplate capacity. That's basically the maximum theoretical output.
And that was an increase from 2023.
Yeah, up over 4 gigawatts, mainly from ramping up their new plant in Alabama and getting more efficient at their Ohio factories. Looking ahead, the goal is to hit around 14 gigawatts of capacity just in the U.S., and 25 gigawatts globally by the end of 2026.
Those are huge numbers. What did they actually produce in 2024?
They produced 15.5 gigawatts worth of modules, and they sold a record 14.1 gigawatts.
Okay. And that included both their older and newer module types.
Yeah. It was about 9.6 gigawatts of the Series 6, their established product, and 5.9 gigawatts of the newer Series 7 modules.
Got it. And that Louisiana plant we mentioned, the $1.1 billion one, where does that fit in the timeline and the overall strategy?
That's a really key piece. It's in Iberia Parish, and it's still on track to start commercial operations in the second half of this year, 2025.
And it's supposed to be pretty advanced, right?
Very. Designed to go from raw glass to finish Series 7 panels in just hours. They say it'll crank out like over a dozen panels every minute. It'll add another 3.5 gigawatts of annual capacity, which is crucial for hitting that 2026 goal. Plus, creating over 700 manufacturing jobs and 500 construction jobs there.
Big boost to U.S. production then, and jobs too. And this is part of a bigger investment plan.
Exactly. That $1.1 billion for Louisiana is part of a wider $4.1 billion manufacturing expansion strategy. The whole plan aims to add about 12 gigawatts of new capacity across the U.S. and India between late 2023 and the end of 2026.
That's a serious commitment to scaling up. Okay, so if they're building all this capacity, they must be booking orders like crazy. What does their order backlog look like?
It's pretty massive. At the end of 2024, their contracted backlog was 68.5 gigawatts.
Wow. And the value of that?
$20.5 billion, which works out to an average selling price around 30 cents per watt, roughly. That backlog gives them huge revenue visibility moving forward. It really shows the demand is there.
$20.5 billion. Yeah, that definitely signals market confidence.
Okay.
Let's talk about what makes their product different. We keep saying CDT technology. Can you break down why that's such an advantage?
Sure. Cadmium telluride thin film is fundamentally different from the standard crystalline silicon panels that dominate the market. First, Solar's been perfecting this for years. They even set a world record for CDT cell efficiency back in 2016, I think it was.
Okay, so it's efficient. What are the other benefits, especially from an investor's perspective?
Well, a few key things. One is sourcing. The main ingredients, cadmium and tellurium, are actually byproducts from zinc and copper mining. So they're basically taking waste materials and turning them into clean energy tech.
That's interesting from a sustainability angle.
Definitely. And critically, it means they aren't tied to that polysilicon supply chain, which, as we said, is mostly in China and subject to all sorts of geopolitical risks and tariffs. Plus, CDT panels have a long track record. They reliably produce power for 25 years or more.
So sustainable sourcing and supply chain security, avoiding that polysilicon bottleneck. That sounds like a strong combo right now. And they're continuing to invest in R&D for this tech.
Oh, yeah. They're putting up to $370 million into a brand new dedicated R&D center in Perrysburg, Ohio. It's supposed to open this year, 2025. That's a big bet on staying ahead of the curve, improving the tech and the manufacturing process.
Makes sense. Got to keep innovating. Now, besides building factories, what about major deals or partnerships? Anything significant potential investors should know about?
Yes, actually, a pretty huge one recently with Energix Renewables. They're based in Israel. First Solar is going to supply over 5 gigawatts of their modules for projects Energix is building in Israel, the U.S., and Poland.
5 gigawatts. That's massive. Is that their biggest deal ever?
By volume, yes, it's their largest single contract to date.
Wow. And when will these projects happen?
The facilities are expected to come online between 2026 and 2030, and importantly, the deal also includes First Solar's recycling services, so it covers the end of life for the panels too.
Right, that circular economy aspect. Seems like a big strategic win. Now, with valuable tech like this, protecting intellectual property must be important. Are they active on that front?
They are. You have to be in this space. Just back in February, they filed a lawsuit against Jinko Solar,
Oh, what was the claim?
alleging infringement of a U.S. patent First Solar holds related to something called Tiapicon crystalline silicon cells. It's a patent they actually got when they acquired a company called Tetrasun back in 2013.
Interesting. So even though their main thing is CDT, they're still defending IP and other solar areas they've acquired. Shows they're serious about protecting their innovations. Okay, let's look at who owns First Solar. What's the investor base like?
Well, it's heavily dominated by institutions. There are over 1,600 institutional owners, and together they hold something like 98.8% of the outstanding shares.
98.8%. That's huge. Who are the big names?
You know, the usual suspects: Vanguard, BlackRock, State Street, Jane Street Group, the big asset managers. That level of institutional ownership often suggests, a belief in the company's long-term story.
Right. The smart money seems to be largely bought in. Does that tell us anything else?
Well, high institutional ownership can suggest stability, but it's also worth noting there has been some insider selling recently. Over the last couple of years, insiders have sold more than they've bought, to the tune of about $63 million net.
Any particular individual selling?
The CEO, Mark Widmar, has been the biggest seller, apparently.
Okay, insider selling. How should investors think about that? It can sometimes be a red flag, right?
It can be, but it's not always straightforward. Insiders sell for lots of reasons: personal financial planning, diversification, exercising options. It doesn't automatically mean they lack confidence. But yeah, it's something investors definitely watch, as these are the people who know the company best. It's just one data point to consider.
Fair enough. What about Wall Street analysts? What's the general feeling about First Solar among the pros who cover it?
The sentiment there is generally quite positive. Looking at the ratings, you've got 2 strong buys, 23 regular buys, only 3 holds, and 0 sells.
So overwhelmingly positive.
Yeah, the average score comes out to 2.96 out of 4, which definitely leans bullish. You see targets like $236 from Barclays, $230 from BMO, $245 from Truist, though they did trim that from $285 and $202 from Jefferies. The consensus is clearly positive on the outlook.
Okay, so institutions are heavily invested, analysts are mostly bullish, despite some insider selling. Let's circle back quickly to that impressive 2024 revenue growth, 27%. Can you just recap the main drivers again?
Sure. It was really a combination of things firing on all cylinders. First, as we said, selling a lot more modules that record 14.1 gigawatts, up 24% year over year. Huge volume increase.
And they got good prices for them, too.
Exactly. Average selling price was higher, around 30.5 cents per watt. That reflects the value of their tech and our U.S.-made advantage. Then a really big factor was government incentives, specifically the Inflation Reduction Act.
The IRA, how much did that help?
A lot. Those Section 45X manufacturing tax credits alone brought in about $857 million in proceeds for them in 2024. That's a massive boost to cash flow and the bottom line. Plus, the IRA also encourages U.S. solar project development, which drives demand for their panels.
Right, so the IRA helped on both the production cost side and the demand side.
Yeah.
But what else contributed to the growth?
Well, bringing that new Alabama factory online was huge. Adding 3.5 gigawatts of capacity allowed them to meet the demand. Their strong backlog and continued bookings, 4.4 gigalevy of net bookings in 2024, showed demand remains strong. They also managed operations well, improving their gross margin to 44.2%. And finally, just continuing to advance the tech, like launching the Series 7 and hitting efficiency records. keeps them competitive.
It really sounds like a lot of things came together for them in 2024. So looking at the big picture now, First Solar seems to be in this unique spot, doesn't it? A major U.S. manufacturer with its own technology. How do you see them navigating things going forward, especially with all this trade tension?
It is a really interesting position. On one hand, their U.S. footprint and their specific CDT tech mean they could actually benefit from protectionist moves like these Liberation Day tariffs, unlike many competitors. But they're also still a global player with international factories and deals like the Energix one.
So they're playing both sides, in a way.
You could say that. They have the strong finances, the differentiated tech, the expanding U.S. space. That's a great foundation. But they'll need to stay nimble, adapt to changing regulations, manage that global supply chain effectively, and keep pouring money into R&D to stay ahead.
So for someone looking to invest, it seems like there's a strong case based on their unique position, but also ongoing strategic challenges to watch.
Exactly. The financial strength is there. The technology offers real advantages in sustainability and supply chain resilience. And that domestic expansion looks increasingly smart in today's world.
This has been incredibly insightful, really digging into First Solar. As we wrap up, what's the one key question you think potential investors should be mulling over right now?
The crucial question, I think, is this. How effectively can First Solar really balance this big push for domestic growth with their existing international operations? Can they optimize both to maximize profit long-term while navigating these constantly shifting global trade winds? Getting that balance right is going to be absolutely key to their continued success.
That's a great point to ponder. Thank you so much for breaking all of this down for us. And thanks everyone for tuning into this deep dive. If you found this useful for your investment thinking, please do subscribe to the channel, give us a like, and hit that notification bell so you don't miss our next exploration of companies shaping the market.